Hi, everyone. Let's get ready and prep for the Fed. Hello, Parmar, Alexander. Okay, got some other Patrick, Mike, Simon. How are you? Mary? Yesterday was a pretty wild day. I mean, you have wicks that, I haven't seen for a while. Take a look at, let's get my screen up here.
Hey, how you feeling today, Coach? Good morning.
I have a ways to go.
You
I'm
do?
in full bloom now, but you know how sometimes it has to get worse first.
Oh, man. All right. Well,
Yeah, I think
go
it's
ahead for
at
a few minutes and I'll take over.
all right, RSV or RVS, whatever it is. So
Yeah, respiratory.
yeah. So what a wick in S&Ps. I remember before I got off with Blake, this is where really confluence of a couple of lines. So, it didn't break out over that long, that's downtrend line. It got there and then almost got to the line that it broke to the downside. That's pretty lousy action, I think.
Good morning, Dale. Hope you feel better, buddy.
Okay. All right.
Yeah.
No, feel like, like I want to make some money. All right. So, why don't you help me? This is a pretty classic looking 3-drive right here in gold.
Yeah, and on what happened into the CPI, there's a quite loud rumors going on that it might have been leaked somewhere, which were the moves like a minute or two before they really hit the market. We were already saying like, wow, what kind of moves do we have ahead of it? And then now it's all over the press as well, especially the move on the S&P and the yields. Seems that there's been a big number of contracts traded just ahead of the CPI. So there's a bit of rumors around that it might have been leaked. But yeah, the moves were pretty wild.
And I've always believed that closes are more important than what happens intraday.
Yeah,
because that's the vote. While the whole candle's voting's going on like an election, but when a candle closes, that's the election. That's the vote.
Yeah.
And that was not an impressive close. I'm sure some people try. This is the breakout everyone was waiting for over the downtrend line from January. Couldn't get there, and then almost got all the way up to that line that Blake has been talking about for quite some time, up here around 4,200. So I don't know. I think that's crummy action. The dollar, I don't think we got down to 102 yesterday, did we? What was the low here? 103.05. We have so many things happening here. But this looks like it's starting to set up for something counter trend in the dollar down. I'm thinking 102.60 or so. So we're still about 80 handles away from that. I didn't like how copper closed on a good number like that yesterday. I mean, again, it kind of spiked, but gave it all back. And I booked the crude. I work with the stock trader, and I've watched him. He has like a 3-day up rule. The market goes 3 days your way. You go to the door. So I'm out of this now.
Well done. Absolutely stellar trade, that one.
So we'll see what happens. I'm wondering into the Fed. The yen looks like it held 78.6 back here, guys. I know that.
Yeah.
What do you think here, Kay?
Yeah, there was a bit of a move this morning again when the press rehashed or brought out some interview as well with a person saying that the Bank of Japan may be ready for a monetary policy review. But we've been talking about that for a few days, if not more. That it's in the possibility. So that was the drop down in dollar yen, but indeed it held right on that line. Going into the FOMC tonight, I'm perhaps not as positive that Powell may stay or the FOMC may still be that hawkish after the CPI, but then We have also to know that the dots, the dot plots, the dots been given by the Fed members well before yesterday's CPI, so they would not have seen the CPI. So we could get an upward surprise on the dots regardless of yesterday's CPI. So that's one to bear in mind. Yeah, I don't know. I think if you look at, of course, CPI is coming down, and that's what everybody is watching. But then there's two big dominoes which haven't fallen, and one is the jobs market, and the other one is that financial conditions have actually eased despite QT. So that I think personally, though, is going to keep them more on the hawkish side of things right now.
I've been reading that the roll-off of QT has been very minuscule.
Yeah.
Hasn't it?
Well, I mean, but it's also, I mean, there's a few factors in there, and one is the reverse repo. People are placing so much money in there that the liquidity hasn't really gone down much. So financial conditions haven't tightened as much as perhaps Powell and friends would have wanted. So
yeah, that's one of the bulls. That's one of the bulls' arguments that, a QT really hasn't been aggressive, and at the Fed, there's still enough liquidity out there to drive asset prices higher because QT hasn't been draconian at all.
And it's possibly one of the arguments why they can just continue for now in the same path, is that assets are still pretty high. So we're nowhere near danger levels in the S&P, for instance. Yeah.
Okay. So how you doing today, Ryan?
Oh, good, mate. You're sounding a bit mopey.
Mopey? Yeah.
No, you're sounding a bit mopey. You doing all right, mate? Hanging in there.
Yeah.
True soldier.
Yeah, I could cut it out for a few hours. So what's your take on the dollar here going into the Fed?
I'm at that point where, we can say it's going here, we can say it's going there. It just comes down to trading it now. We're on some big levels. We've got some big levels up ahead, down below. We've had some markers. Dollar yen set its marker down in that sort of 133.60 area. We couldn't get down to those lows over the CPI. That's really going to be a level. There's a whole big load of tech down at the low 133s, fibs, support.
Okay.
Going to be a big level down there. Then you look at euro dollar. It's had a break over 106. Next big level up into 108. So, if the Fed are going to be a bit less hawkish, and we're going to see the dollar sell off, that's the big level to watch up at that 108 area.
Okay.
If you take it out to maybe,
how do you come up with the 108? What do you see to the left? That
I was just going to say, if you take it out to maybe a weekly or just come out a bit further, it was a big stopping point on the way down.
Here you go. Right here.
It goes even further back than that. Goes back to 2016s, 2015s. It's one of those well remembered levels, if you like.
I remember 109.
Yeah.
But 108. Yeah. So I think kudos to Grega. He said there'd be another wave in to the downside in the dollar, upside in euro. But then now I think we're close to completing the first wave. So this is just the first wave. If you believe there's going to be a longer term bear market, I think there's got to be some very sharp bear market rally in the dollar, sharp pullback in cable and pound, but just fib retracements. They could be deep, but I think we're close to finishing this. We're much closer to finishing this than we were a week or so ago.
Well, your 109 is the let me check my screen. Your 109 is the 50 fib of the April 2021 move down, or the May 2021 move down. So when you get all your ducks aligning like that, it's also the underside of a longer term trend line going back all the way back. I'll need to zoom out a bit now.
right.
Going all the way back to the 2000s. No, sorry,
Okay.
I'm talking out my arse. Going all the way back to 2017. So you watch everything,
Right here.
and then
Yeah.
you look at what the price is going to do. If the Fed's going to be less hawkish or dovish, then euro dollar's going to rally. Well, where can it rally to? Your 108, your 109 areas. That's where it's going to run into trouble. If you manage to grab a long on that situation, that's where you look to take profit. If you want to fade the move, that's where you maybe look to scale shorts.
Do you have an analogous level in cable?
Anywhere you like, mate. Lick your finger and stick
120.
it in the wind.
All right. Yeah, I look left. I don't know.
Because
where would it be? 130.
Yeah, as you know, we said it before the CPI on Face. I said it could be trading 122, 121, or 124, 125, and
Yeah.
it was 124. We've got the Bank of England tomorrow. It has it's got the possibility of being a complete and utter mess, as we like to make things in the UK. So again, we could be 126 or we could be 120.
Yeah.
I don't want to touch cable.
Okay, you got to think that heading towards 70 in Aussie could mean something. Well, there's a 200-day right there.
Yeah, again, 69, a big level. It's also a big fib level, 69, 16. The big figure on its own. K's got a trend line going through. We got the 38.2 fib of the 2021 move at 68.70 still, which we're knocking around.
Okay.
So again, if the market wants to do it, those are the big levels it's got to break. And if it goes, then you can either go with it or you look for your places where it's going to run into trouble.
Okay, thank you, Ryan.
No problem, sir.
So, so Dale,
thanks.
Dale, I was going to say you sound like you're doing a little bit better. So I just want to.
Sounds like he's smoking 50 a day.
Yeah, you could. I wouldn't mind if you took over now.
All right. I'll do that. We got a lot of setups ahead of the Fed today. I want to commend your efforts, Dale.
Thanks, man.
On being here. And who do you have as an interview today? You have Mr. Keller, right?
Yeah, that's why. Another reason I wanted to grill. I wanted to come here and grill him.
All right, cool. Well, you know what? Take a break. We got about 20 minutes until Dave gets here, and you can take the interview from there. So
thanks, Blake.
So good morning, team. Good morning, all of the ForexAnalytix community, the F.A.C.E community. We do have a big day today, and you were just talking, Ryan, about the euro. What I'm pointing out right here is the spike low from the post-COVID lockdown spike low is right where we're at. That's right where we're stalling. Like if you look at, this is the March 2020 low, we went into COVID lockdown, the dollar ripped, and here we are. I mean, yesterday we spiked above it, couldn't hold it. Today we've been above it, can't hold it. You can just say it's about 106.50. I think this is pretty critical resistance. I mean, where we're at now. I want to point something out really quick, and then I want to talk a little bit about the euro and the dollar. And I just want to recognize how wrong analysts were really a few months ago. The thing about the tone of the analyst community in the currency market 4 or 5 months ago, talking about it's going to be a long winter in Europe. We have this, the Russia-Ukraine situation, yada, yada, yada.
Parity.
I'm sorry?
Parity.
Parity. Oh yeah. We're going back below parity. I was just talking about when we were trading around the 101 area just like a month ago, but yeah, I mean, you're talking, we're below parity. We're going to see 90 cents. There was a lot of really, really bearish calls in the FX market a couple of months ago. And the analyst community was completely wrong there. So here we are. Now we've rallied to 106. You're seeing people that are thinking that we're going to 110. How likely are we going to 110 right now? I mean, you look at the price action yesterday, and stocks rallied in reverse. Now, I don't want to, you know, get you too excited here, but that's a false breakout. And you guys that know me, and you know me well, and you hear me all the time, false breakouts lead to breakdowns. You know, people get John G'd, they get caught, you know, chasing the market, you know, to new highs. They don't realize that they just get, you know, wrong footed, and false breakouts lead to breakdowns. And so in this case, we have that. Now in the dollar was less responsive. We had this move lower in the dollar index, and you can see the dollar index didn't close back above the breakdown point. The euro didn't close back below the breakout point, you know, which is 106. So I think the dollar is less convinced than the stock market is at this point. But I think those are risks that we are facing as we head into FOMC in the last few months of the year. So, Ryan, because I was starting with you, what do you think about the euro at current levels? I mean, do we see 110, or are we heading back to parity this time?
Well, you've got a big level there, and you're right to highlight it. But you've got to take the situation into consideration. We've got a big event tonight. You know, the reality is this could be trading 104 or 108 by the end of it. It's really 50-50 where we can go. So really, what I do with these big levels, that you've got a big level here. Okay, we're right on it at the moment, so it's not going to mean anything over the Fed on big news. But you then use it if the price moves away from it. So if we move above it to 108, that level you've got there becomes your potential support point on any pullbacks. It becomes an important level on the other side. Conversely, if the Fed sends it euro dollar lower, it's still your resistance point. So, you know, you've got one line now, and it can play two ways. But in terms of what the euro does, yeah, you know, that's why you only listen to analysts with a pinch of salt. And you should be listening to the analysts here, because, you know, we were pretty much on top of what the price was doing down at the lows. It weren't going down anymore. So the bounce was natural. You know, I played it in Aussie dollar. Others played it in euro dollar. So, you know, if you're going to listen to analysts, listen to the ForexAnalytix ones.
Yeah, you know, I'll tell you, I don't listen to analysts all that often. They often bring up good talking points, and that's why I do read a lot of bank research.
You know, you do your own analysis,
right? You know, they provide for good fodder for us to chat about, and that's pretty much it. As far as, you know, remember, analysts are paid to be analysts, not traders, and they're paid to be, you know, predictors, and many of them are just not that good. So let's just face that. Now we are at a pretty pivotal area in the euro. Somebody just asked, you know, how do we know if breakout's false or not? I like to look at daily closes, because you think about intraday, who gets caught, right? Think about like a, you know, hot potato, you know, the old hot potato game, or, you know, maybe you know, musical chairs, you know, who's left without a chair. That's what happens in the market. So when you get like the S&P, we broke higher, you know, following the CPI, you can see everybody's, you know, got squeezed, you know, who's got the hot potato, and they got squeezed out, and we closed well below the breakout point. And that is now a real risk for stocks. And you have to think about that. So if the stock market does break lower, you know, following today, let's say Powell and you know, I heard K-Man's comments a little earlier about Jay Powell might be, you know, and the FOMC might be less hawkish. Could be. You know, is that going to be enough to fuel, you know, the S&P higher? You know, maybe. I mean, we're going to find out. But I'll tell you what, if the FOMC and the dot plots look, you know, like, hey, we're going to see, you know, rates, let's just say following today's dot plot reading, everybody goes, oh crap, the Fed's going to hike at least another 50 basis points going into 2023. You know, we could see the S&P sell off for the next couple of weeks as we head into Christmas. And then we get the old famous Christmas to New Year rally when the market grinds, when there's no liquidity, which, you know, I think could be very well be the case. And it's not the case that I wanted, just so everybody understands. What I was really hoping for is we get and what I'm really hoping for is I hope we get a market rally towards 4,200, then a reversal. We didn't quite make it up there yesterday. You guys know that's been the plan, but you know what could happen is we can make a dip back down to 3,800 before Christmas, and then, you know, get a little bit of a recovery from there. So either or is possible. So, you know, let's go back to K-Man really quick. What would justify, K, if you're still here? Are you still here? Okay. Hey, what would justify a hawkish Fed in your opinion?
Well, that's what I said earlier. I don't think that they will be dovish. First of all, because the dot plots have been submitted already well before yesterday's CPI, and then the job market is holding up, and financial conditions have actually eased versus what Powell would like them to do, and that is tightened. So I don't think they have a big case for going all dovish tonight. Now,
I think the question that Blake's asking.
The thing is, though, it does look like the market wants to see a lower dollar. That they want it to see it lower. It's a lot of people are probably willing to see through the FOMC tonight, or if we get a dollar rally, trying to sell into it. Is it justified? I don't know. As I was saying this morning on the Flow Show, I do think that the dollar, if it's a correction, we're close to levels where it's getting very, very interesting. Aussie, Kiwi, Euro, dollar yen, you name it. Dollar China, dollar Noki, you name it. There's a few dollars who are on important levels. Sorry, Stel, go ahead.
No, I was just going to say, I think Blake's question is, what do you think? What do the Fed have to say for us to consider it being hawkish? And to answer that question, we have to look at
on the same path.
Yes, if you
don't
look at
change anything, it's going to be hawkish.
But yeah, well, let me ask you guys this, and Stelios, I want you to finish your thoughts. I mean, is 6% year-over-year CPI? I know we see all the disinflationary pressures coming, but you know, is this still justify, you know, that the job is done here in the stock market?
In terms of bringing down inflation, no.
Yeah, I mean, you know, should the Fed, like, you know, announce that, hey, we've won, mission accomplished.
It shouldn't be.
We can bring rates back down to 2% now.
Shouldn't be enough yet, and they've told us in the past they will rather err on the side of over tightening rather than the opposite. So, of course, their job is not done yet. You have to see inflation prints a lot lower, you know, basically inflation prints at target or below for them to start saying we're done. Now, the problem is that they can see the trend, and Joseph Wang has told us in the past that the Fed look at 12 to 24 months forward. And if they project that far forward, inflation is coming down, and it will come down. The question is how far, you know, how much do they want to err on the side of caution in terms of being more hawkish than needed, and I think they've told us that. They've told us in the past that they'd rather do more than less. So I think for now, the risk is for Powell and the Fed to be more hawkish than expected. And look what Fed funds did yesterday after the CPI, which admittedly was lower than expected. We've shaven about 15 basis points of hikes as a terminal rate. So now we're pricing well below 5%. And so after this 50 today, which I think is given, it's going to be 50. We're pricing less than 50 more. So what are the chances that Powell and the Fed are going to tell us, yeah, we're not going to do 50 more, probably going to be, you know, maybe another 25 or maybe another 50 tops. I don't think they're going to tell us that. That's
no, why would they?
Yeah, that's the risk I see. I think eventually they're going to pivot in a big way, and I've said this so many times. I think Q1 and probably end of Q1 2023 is going to be when they really hit the brakes. But the risk for today, I think, is for them to be more hawkish than expected. So you have to be prepared for that, I think.
And you know what else you got to be prepared for? We got to be prepared for rates to stay elevated all of 2023. And I think that's what, you know, I had this conversation. If you guys haven't seen it yet, make sure you check this out. Here, I'm going to put a link. It's free for you guys to listen to. This is with where'd it go? This is with
Top left.
Oh, there
That
it
one.
is.
Yeah.
This is with Michael Brown. And I just did this interview yesterday, so it's fresh off the press, guys. If you have not watched this, watch this when you're done here. Well, after Dale's interview with Dave Keller, because that's going to be a good one. That's set up
Watch
with
them
Michael.
simultaneously.
What's that? What's that?
Yeah. watch them simultaneously.
You're right, exactly. No, it's a good interview with Dick Matthews, and actually Dale just interviewed him for the very first time here just last week, I think. And then Michael Brown, who's awesome. He's used to be with Canton. He's with Trader X now. And check that out. I think it's a really, really good interview. Just kind of prepare ahead of the Fed. But one of the things that I think that we really have to, the market just assumes that when the Fed gets in a pickle, or we have a slowdown in the economy, the Fed's going to automatically lower rates, and I am a product of that. I mean, I started trading in the mid 90s, so I only know a Federal Reserve that says, oh shit, we got a problem. Let's lower rates aggressively, and that'll cure everything. And we are in a new regime now, and we are in a different situation with this persistently high inflation. And I know everybody's like, well, inflation is coming down, but is it? I mean, where's the CPI going to end up bottoming out? Maybe 4%, best we can see right now. I mean, I don't know if that justifies, everybody's really, big calls on rate cuts going into 2023. I don't see it. But anyway, I think it's going to be a big risk.
The thing is as well, is that Powell told us that they want the whole curve to be in positive territory. So we were originally thinking that it was like the real rates, but they apparently seem to talk about the nominal rates, which would mean that inflation has to come down to 4% before the whole curve will be, or risks, or could be in positive territory. So there's a bit of uncertainty about which exact rates they talk about. But it would mean that inflation has to come down to 4% before we can even think about it.
Yeah, great point. Hey, look, I think somebody asked, I forget who asked, but are we going to have, live FOMC coverage like we had yesterday with the CPI? No, FOMC coverage will be live in our chat rooms. If you haven't been in our chat rooms, this is what they look like. So you can see, everybody commenting, and, we got massive discussions going on all the time. These are threads, so you can you can talk to somebody directly from here. And then, but what else is happening is, we have the World Cup happening. So, I mean, I don't know how many people are going to be watching FOMC versus watching, Morocco beat France. I mean, I just don't know. Oh, did I just say that? Yeah, I did. I didn't mean to say. I was joking. I'm joking about that. You guys know it's what's going to happen. Anyway, we have a huge discussion on the World Cup, in the ForexAnalytix community. So this is where we'll be at. So if you want to try it, jump in the trader funding program, trade our money, or you go over here to ForexAnalytix and sign up it's $1 for a day, or for 10 days, excuse me. And try it out, and then download the mobile app while you're at it. All right, a lot of great stuff. Ryan, K-Man, Stell. I don't know if Steve's here. Steve was addressing. Here. Oh, Steve, hey, how are you? We got a couple minutes before Dave Keller comes on. Any thoughts before? I mean, I know you're pretty one-sided about Powell. So, what are some quick thoughts here? And we lost Steve.
I'm here, mate.
Oh, I asked, do you have any quick thoughts?
I've said what I think multiple times. I think that Powell is definitely not going to give market participants what they want. So
you think that he's going to be just uber hawkish, and how do you think the market's going to respond?
I don't know if he's going to be uber hawkish, but I think he's not going to be dovish at all.
Okay.
It's worrying when we all agree. I'm a little bit worried now.
Well, you know what? And that's probably one of the reasons why stocks are still, I mean, I know we're down right now, and I know we had this false breakout from yesterday. However, maybe that's one of the reasons why equities are trading up where they're at. I mean, the markets have really priced in this, China reopening. China is going to reopen. We've seen this nice recovery from the lows. I guess the question is, what else can we look forward to? I mean, I don't think the Fed's going to be telling us that rates are going to be coming down anytime soon, right? So I don't know. It's going to be interesting. Well, last minute thoughts. Stelios, last minute thoughts here.
Just be careful today. That's all.
Yeah. Yeah, I mean, to look at yesterday, I mean, that was some whippy action. I sold euro yesterday while we were live here.
I remember.
Yeah, I sold at 106.40 and I covered it at 106.10. Like, later on,
Yeah, you did that because you saw the S&Ps coming off.
Yeah, and one of the things, and just
why didn't you sell the S&Ps? That was 100 handles.
What's that? Oh, that's the thing is I sat here and said, why didn't I short the S&P? Here's you can see when I actually traded the euro a couple of different times yesterday and covered it a couple of different times. So I reshorted it again. So it was all over the place. This is our trade. This is our trades room, guys. If you want to know where we place, like where we're getting in, like I just got out of half of my Aussie New Zealand today of my long. So anyway, that's our chat rooms. Ryan, last minute thoughts before Dave comes on. I'm sorry, we're bleeding over now.
Yeah, trade safe, folks. If in doubt, stay out.
All right, K-Man. He might have split already. I think he already split. All right, guys and gals, I have
a question for the attendees. Ooh. How many times after F.A.C.E have you guys sat there and wondered, I wonder what Blake and Ryan and K-Man and Stell are doing right now? And it's a real easy thing to solve. Anyway, I know I do, but I could always jump in. So, you could jump in so you can know that Blake posts everything that he does. So
pretty transparent.
Yeah. So I just wanted to lay that out there because I know people think about it, because what we're saying right now could shift in an hour and a half. Right?
That's right.
Okay. So David Keller is here with us. Dave, welcome back to F.A.C.E.
Hey, good morning, gentlemen. How are you?
Good, David.
Mr. Keller.
I got out of a sick bed because I wanted to grill you today.
I'm honored. I'm honored.
Are you honored? Yeah, my doctor is real happy about this. But you know what really caught my attention, Dave, and I want you to expound on it. I believe I caught a tweet that you put out there, or it was based upon one of your shows on the Final Bar, where you said that the market has already had enough duration for the bear market to end. Am I reading that correctly? That duration and the amount of time that we've had from the beginning of this year could be enough time for a bear market to complete. I think you were talking about duration.
Yeah, so this is where it gets kind of tricky, and it all depends on the dreaded R word, recession, right? So if it's sort of the average bear market, we're kind of there in terms of price and time. We've achieved what I think would sort of fit into the category of the average bear market phase. However, if you isolate recessionary bear markets, they tend to be deeper in longer duration in time and deeper in terms of price correction. So I've often thought about, like, what's the benefit of debating whether or not there's a recession, because it's a common question I get asked. And my answer as to why it makes sense is because when you look back in history and look at the times where the economic conditions really deteriorated to the point that you label it appropriately, probably as a recession, that's where the bear markets can be much more painful. And I think that's the biggest concern going into the first half of next year, is that does play out, which means we're probably not done, unfortunately.
Okay, so I would call that the consensus view, wouldn't you? That the lows that we had in October, which took out the July lows by a little bit, that during the first quarter or so, when earnings and growth becomes more of a concern, we're going to flush that out, trade down towards 3,100, 3,300, the COVID, the pre-COVID highs, and that could complete it. It almost makes me think that the market is okay through the first part of the year as a contrarian view, that it could be okay and through the spring, and that the Fed, maybe after the market thinks we have a pause, has to restart its tightening campaign because inflation really isn't going away, and then we have the big break, sell in May and go away. What do you think?
It's a really interesting point. I mean, and one of you guys mentioned, I forget, I couldn't tell who was a little bit ago, just mentioned, we're all in agreement. And that makes me a little bit uncomfortable, something along those lines. And I think that's true. The target I've been giving for the S&P is 3,200, which is a key Fibonacci level. And I'll show you the chart that gets you there. If you take the sort of the larger framework of the market from the March 2020 low to the January 2021 high, a couple key levels, and it's sort of these pink shaded area, the pink horizontal lines here. That first one down 38.2% was 38.15. Second one's 3,500, which is where we hit there. And I know Blake despises the 50% level, but Blake, sorry, there it is at the October low. And then if we would break that, 3,200 is the ultimate objective. And I mean, years from now, if we get down to S&P 3,200 or roundabouts and then rally from there, that will be the most beautiful use case for Fibonacci retracements I've ever seen. But what concerns me is the fact that that's very much a consensus point of view, that we are not done with the downtrend. And it's so funny behaviorally, because yesterday I'm driving into the office around like 7-8 a.m. Pacific time, which is when the market's just opened, and the S&P's rallying up to 4,100, getting above this big green trend line that I've had on my chart for a month or two.
You and the whole universe.
I have this whole like narrative in my head of, okay, apparently we're rallying hard into the end of the year. What does this mean? How like it's 3,200, so the objective. And then by the end of the day, we're right back below the 200-day moving average, which is 2022 in a nutshell in one day's trading, I think.
Yeah, I mean, there's probably some people stuck that went with that news up there. Do you think we work back down towards, say, 3,700, or is the pullback was mainly because people just didn't want to be long in front of the Fed? I think that's, how would you define that bar, or if you had a candle? What would you say about that one day? Is it a negative day? Is it a neutral day? Is it an important day where the range will give you a signal? If we take out the low of yesterday, or we take out the high of yesterday, we've got a signal.
So you mentioned candlestick analysis, and candlesticks are so valuable in my opinion, because when I've learned them, it tells you about the sentiment, but on a short-term basis, right? We have a lot of tools that tell us about longer-term sentiment, like money manager surveys and AAII numbers and stuff, which are more longer structural kind of things. Candle charts tell you moment to moment, how is this picture changing? And if you look at what actually happened, so this is the candle chart, and you can see my lines are still on there. Here's the big trend line coming down off of the 2022 highs. So a couple observations, right? One, when we open and then have a big, down close by the end of the day, and there's this big solid candle, a gap up and a solid candle, that shows you there was a disconnect between the catalyst that pushed the market higher at the open and the catalyst that drove the market lower during the day, right? And what candlestick analysis really reinforces is the importance of the direction open to close. And when you gap higher and close lower, that's usually not a great sign, because that tells you people were really excited about taking profits when we went up a little bit. And it's not lost on me that it's right at 4,100, which is right where we peaked out at the beginning of December. So we now have this level 4,100, which has been met with sellers a couple times now. And every time we reinforce one particular price level, that immediately becomes an important level, I think, to the market, and certainly in my analysis. So when you're looking at a day like today, which is Jesse Livermore said there's a time to go long, a time to go short, and a time to go fishing. And if there's a sit on your hands day, in my opinion, it's this one. I think this is a period. I mean, this is going to be a volatile session with a very unclear outcome. I think after today, you get a much better sense about what now to year end and the beginning of January probably looks like, because I think the tone of the Fed, and particularly Powell's press conference, is going to be really dissected by people and picked up on very quickly. But I'm not seeing yesterday as a big vote of confidence that we're going to get this soft landing, everything's great sort of feel. It's more of a, wow, I have a chance to get filled at 4,100, that sort of range. I have a chance to get filled on a gap higher before, this sort of craziness. And people were thrilled to take that because there's a non-zero probability that this is a painful day.
Okay. And I don't think the market can make a lot of progress on the upside with the way Apple looks to me. You want to pull up Apple, David?
Yeah. So, one of the great things about equities is you can look at a bunch, you don't just look at the indexes, you can look at breadth, right? So you can measure participation. You can look at key names like Apple, Amazon, Tesla, and particularly when you think about sectors, you can usually look at a couple names and understand why that sector may or may not be in a good position. And if you look at Apple, if you bought Apple in August of 2021, you're flat for that period, which is crazy on a company like Apple, which is literally completely stalled on its uptrend. So on a long-term basis, you have a stock that rallied into the new year, and that was it. And it's had a number of failed attempts to re-achieve that level and has been unable to do so. And now you're literally sort of in the middle of this range. You could call this, I'd probably call this just a consolidation pattern, a basing pattern of some sort, but you're now within what we loosely call a range within a range, right? You sort of have this broader range that we set in 2022, right? But then we have this narrower range that we set with the 200-day moving average looming very large above current levels. So this is not the type of chart that looks encouraging. This is what John Bollinger, years ago, talking with John, he would talk about the idea that volatility would often lessen before the big break, right? You have a big, a lessening of volatility, sort of an equilibrium. The market's telling you that Apple's worth about $145 a share. And it's been agreeing on that fact for the last 3 months. And we've just been trading around that equilibrium, I would argue. But at some point we break, right? And what concerns me is a stock like this breaks that pattern to the downside. And then there's real concern about the broader market.
Right. Okay. 7-8% of the market cap of S&Ps. So
and if you look at the XLY, right, or excuse me, the XLK, the technology sector, right? It's even bigger, right? You have Apple and Microsoft, which are dominating that ETF too.
Okay. And where are you with the dollar, David? We've had a huge 10, 12 figure break in the Dixie. And 104 was a big level that we took out. And I know that you're holistic in your approach to the market and you pay attention to this. I was wondering what you were, you got a 50% Blake's hated 50%.
Now I'm just doing this despite Blake. All right. I'm doing this on purpose now.
Hey, I'm still listening.
All right. Well, you know what, Blake? W.D. Gann was a big proponent, but you can't argue with him because he's gone. But he was a big proponent of 50%. So we're approaching that. That looks pretty ugly, doesn't it? It looks so ugly, I want to buy it.
So right, so you have a very contrarian feel to your tone here today, Dale. But I hear you, and I think to your point, do I follow the dollar and oil and gold and all this? Absolutely, and before 2022, I could accept an argument that maybe you wouldn't need to and the argument I was told years ago as an equity investor was just look at stocks and everything else is reflected in the price of stocks. But in 2022, if you had two charts, right, a chart of the US dollar and a chart of the 10-year yield, and you didn't have any charts of the S&P or anything else, you probably would have a really pretty good sense about what was happening to risk assets. You'd have a good idea about what leadership themes were because it was a clear, with strong dollar and with rising rates. That's a I think an easy lean into the value oriented parts of the market because that's what's going to do well, and it's not going to be a growthy market. So this is one of those years where, as an equity investor, you could look at other non-equity charts and get a pretty good sense of what's going on. And the chart of the dollar tells you, I think, why and how the rally that you've seen off the October lows really happened, right? The dollar has been sort of the wrecking ball for risk assets for most of this year. That changed a great deal. You can see what I call a change of character in the chart, right? A clear uptrend, higher highs, higher lows. The momentum in a bullish phase, and that's a Connie Brown, Andy Cardwell thing where you're using an indicator like RSI, and you look how the whole range moves to the upper side, right? And when we pull back, the RSI doesn't get much below 40. When you rally, the RSI often becomes overbought. and that's the sign of a healthy long-term uptrend. But look at how all of that changed here in October into November. We went from being above the 50-day to below the 50-day. We went from the momentum being in that bullish range to all of a sudden breaking below 40 and now remain a phase for the last 6 weeks. Now we're breaking below the 200-day moving average. We're breaking below the first Fibonacci support. We're kind of, in a bullish market, resistance levels should be met and eclipsed. And in a bearish phase, support levels should be met and fail. And that's what we're seeing with the dollar. So as a trend follower, which is more my discipline, I see this as a chart going lower. So I'm not inclined to fight this until we find some sense of stability. And until that happens, it really is telling you that there's space for equities to move higher until you get some sort of bottom here. The trend line that I would be looking at, just like the S&P is testing a trend line from the 2022 highs, you see the dollar's actually testing a trend line from mid 2021 to early 2022. That line's up just above 103. So we're actually not too far, with your contrarian hat. That's a line I'd be watching. And I think there's a potential that we bottom out not too far away from current levels, which if that would happen, I think that's a clear risk off sign for stocks.
And, yesterday was a pretty classic example of the market equities not making hay over a weak dollar. And it's been that way for a few weeks. The dollar keeps making successive lower lows. And last week was a pretty negative week in S&Ps. I think we were down 100 handles.
Yeah.
And there was no flight to the dollar. So
No.
for some reason, the market is either because maybe the dollar's getting close to where we have a reaction, which I think is possible after a huge parabolic move to the upside. Does it just whimper and die, or does it give you one last echo rally, a hurrah, even if it's a failing rally? But I don't like the way the market really hasn't made a lot of headway with the dollar. The dollar didn't give it up like the S&Ps gave it up yesterday. And it was like that all last week. The dollar was weaker and the market was still lower. So for some reason, what should be a tailwind for the market isn't acting that way.
And there have actually, Dale, been a couple of those. The other one that comes to mind is the VIX. So, right, there's this normal kind of inverse relationship between stocks and volatility. So, stocks coming down usually means volatility increasing and the opposite. But you've had a number of days where, the S&P, the NASDAQ are up, the VIX is up, which, of course can happen, right? Because they're measuring two different things, and the VIX is volatility, and markets can rally on higher volatility, which is what has been happening here recently. But there have been a number of sort of kind of normal behaviors in 2022, and a lot of those have become disconnected here in the last couple of weeks, which again, that doesn't make me feel great about the sense of things going into the new year. It's not, I think the market appreciates certainty and it doesn't like uncertainty, and I'm getting a lot of uncertain vibes here.
Okay, well, the star for, we're almost into 2023, so this is the time of the year that we reflect on 2022 and then take a look ahead for 2023. The star of the show last year were oil-related issues. We've had a little bit of a pullback here. How do they look to you?
Yeah, so let me see if I can find the chart that I'd love to show you, because if you look at, here we go. So it's been really interesting because if you look at oil and gold, for much of the last year, they've moved together beautifully. So the chart here, just so we're familiar, the dollar's at the top here. So just compressing the chart we just looked at, crude oil here in the middle, and then gold on the bottom. And we've had this scenario for, sort of the middle of the year, stronger dollar, weaker risk assets in general, and including commodities, right? Weaker oil and weaker gold with some random counter trend moves, but overall the trend was pretty consistent. And look at how much that's changed since sort of mid-October, right? You have the dollar moving lower, as we just talked about. You have crude oil coming down as well, but you have gold spiking to the upside. And what's interesting about that is there's now this divergence, and gold has not been the risk or the safe haven that I think many would have expected. Thinking of 2022, biggest surprise for me is if you told me before the year the markets were going to be struggling, equity markets should have been struggling, inflation was arguably the main reason why that was happening, I would say buy gold and just wait, and it's probably going to be a really good bet. And on a relative basis, you did okay with that bet, right? In 2022, gold outperformed stocks, but
by not being down as much.
Yeah, but it's not a feel good like, wow, I had a great year type of thing. It's just getting back to zero, right? After rallying off of the lows there. So I think there's this disconnection now where commodities aren't as much an asset class, and there's a little more dispersion between them, or a little more differentiation between them. And I, for me, oil now in a downtrend, I think breaking below that sort of 75 level was pretty important. If we can get back above there, I think this chart can look pretty encouraging. And in the short term, you've got a trend line just taking the November and December highs, and I think getting above that would be, anytime you have a big a breakdown like that, a lot of times taking the highs there and just drawing a trend line off of those levels, and I can do it real quick, is a really good way, just a visual cue as to when that trend may be evolving. So like that would be the way to look at oil. I would be doing the same thing with gold and sort of looking at this line coming off the lows. And again, as long as we hold that line, it tells you that the trend in gold is safe. When we break that, it doesn't necessarily tell you we're going to zero, but it tells you that something's changing. And I think at this point, you have a clear, sell oil, buy gold trade that I don't know if that's necessarily done yet.
Okay. So looking ahead now, Dave, into 2023, are there any things that you're looking for that you're getting, maybe you don't have the clues yet, that you think are setting up for next year?
Yeah, I mean, I think I was asked in January of this year, what's the chart, like the chart, right? What's the chart you should have? And I didn't, it wasn't exactly this, but it was really close to this one. It was basically the 10-year. And that was probably pretty decent. I mean, the dollar may have been a little better of a call, but overall, this was pretty good. And I feel I feel that this was a good read. And what you're looking at here is the 10-year yield and then value over growth. So when rates go higher, value stocks tend to outperform. When rates come in, value stocks tend to underperform, or growth stocks tend to do better. And that's tracked just beautifully, right? I mean, just looking at how rates impact equity leadership. A year where, cyclical stocks are dramatically outperforming technology and communications things. We've not had one of those years in a long time, right? And so that was a very different feel to this market. I don't think that necessarily is going to stop. And I think it's the question is interest rates. And I've heard really smart people debate with me the high in the 10-year is in, or it's not that much above there. And I've heard others saying rates are going to be higher for quite some time. And that's just something we need to be familiar with. My sense would be more the latter. I mean, I don't think we've seen the high in the 10-year yet. And I think higher rates are going to be an issue we're dealing with here for not just now, but I think going into next year for sure, and probably beyond that a little bit. And what that means is it's not just a 1-year anomaly that value stocks outperform. This could be more of a structural, change where we have a period of leadership from areas like financials that we're not used to being leadership anymore. So I think, this chart is going to be a key one to look at going into next year. Obviously, we'll get, probably some sense of that today from the Fed. But I think going into the beginning of next year, that's going to be one of the most important questions, is what you see in the fixed income markets. On top of that, the yield curve inversion is indicated at the bottom, just the 2s versus 10s. The longer and deeper that inversion exists, well, I've heard a lot of discussions as to why that should not be something we worry about. I've learned an inverted yield curve is usually not a great thing, and usually means that a bear market phase has a little more, is more sustained because of the recession that it usually is indicating. So I think this chart, in terms of tracking the yield curve and tracking leadership in equities, could be really interesting. What's interesting on this chart, by the way, right now, is if you look, these two series, the 10-year and value versus growth, has tracked really well until the last 6 weeks. And while rates have come down, obviously, quite a bit, value stocks are not dramatically outperforming at or underperforming at the moment, right? Growth has not sort of emerged and taken over, which is what you might expect. Given that, it's sort of been a wash. And so there's this real, again, as I mentioned, uncertainty. There's sort of this choppy market in transition feel, where a lot of indicators that have been really consistent in 2022 are now sort of in a pause. And I think it's all probably in some way related to the time of year, right? We're in the seasonally strongest part of the year. You have the Santa Claus rally, sort of the year-end window dressing, all tax advantaged investing, all these things in general tend to give a bit of a boost to stocks. But January tends to be the seasonally weakest month of the year, or one of them. So we're setting up for sort of a choppy, neutral net, maybe, lightly positive December, but I think that's setting up for a painful January. When we sort of come back from the holidays, wake up from the holiday hangover, and then realize that all of the challenges that we've been facing in 2022 aren't necessarily all wrapped up yet, and that there's still more to be done in the new year.
Okay, great synopsis of what we have to look forward to, more uncertainty. So anyway, I've had a lifetime of uncertainty, so I'm used to it. So anyway, David, the best way for people to follow your outstanding work on stockcharts.com and be able to tune in on your programs that you do there, how do people do that?
Yeah, thanks so much. It was always a pleasure to come on and chat with you guys. I'm on Twitter at DKellerCMT, and look forward to seeing you guys there. My show is called The Final Bar. I host the Closing Bell show on Stock Charts TV every day. Dale, you've been a fantastic guest, and hopefully in the new year we can get you back on there again. So you can go to stockcharts.com to check that out. And then my YouTube channel is called Market Misbehavior, and I post a lot of charts like this and thoughts. So you can check me out there as well.
All right. Well, David should be part of your intelligence gathering from here on out. So I really appreciate, you being part of our family here, David. And I wish you and your family, we all do, a great holiday season and a great 2023, your best year ever in all ways.
I appreciate it, Dale Blake. Thanks so much for including me this year. I hope we can continue it on, and have a great holiday. Okay.
All right. David Keller, everybody. And I'm going back to bed. No, I'm not yet anyway. So thank you, David, and you could join the team in 20 minutes on the Morning Edge. Good luck today, everyone, on the Fed. Don't worry about it. If you do nothing, the markets will be here. Make sure your capital is, and take what I say to heart. It's not an easy thing to do here, and you guys don't know how much I've learned from the team over the last 6 years I've been with them. I'm a much better analyst trader than I was when I first joined them. So if it could happen to an old dog like me, just think if you're early in your career, that you form good paradigms by being around people that you learn from that are better than you at this time, gives you something to shoot for. And don't just count your pips, count your blessings. Thanks for your good wishes, and we'll see everyone tomorrow. Adios.